Do you want to get into private equity? What is private equity, and what are the other things that we need to know about it? Today we will dissect another term that we usually see or hear in the business and finance world. This is familiar to you if you are into businesses. You may be planning to invest in private equity, but you are still trying to go deeper into what this is. You have to watch this video, and we will impart to you what private equity is and all the other things you need to know. First things first, what is private equity? Private equity, as used in the financial industry, describes the practice of companies investing in privately held or non-publicly traded companies. Private equity refers to the activity of making investments in privately held companies, and private equity firms are the corporations that engage in this activity. Private equity refers to investment partnerships that buy and operate firms before selling them. They handle these investment funds on behalf of authorized and institutional clients. Private equity is frequently combined with venture capital and hedge funds as an alternative investment. Because investors in this asset class often need to invest substantial sums of money over years, access to such assets is restricted to institutions and high net worth individuals. Now we will show 6 other things about private equity. And first is, number 1. Private equity firms can give businesses the funding they need to expand their operations. Private equity companies, the most frequently used leveraged buyouts to create returns, LBOs. In an LBO, a private equity firm will use a mix of debt and equity to buy a majority interest in a business. After that, the company will try to enhance its business operations and financial standing before eventually selling it for a profit. Private equity firms frequently make growth capital investments in businesses. Growth capital investments are often small holdings in companies that want to grow, extend into new industries, or acquire other businesses. Companies might cooperate with private equity firms for a variety of reasons. One explanation is that private equity firms can give businesses the financing they require to expand. Small and mid-sized companies that might need access to more conventional sources of finance, like banks or the public markets, can particularly benefit from this. Private equity firms can offer businesses operational and strategic experience, which is another justification. Private equity firms frequently employ teams of individuals with knowledge of business expansion. As a result, they can offer the management teams of the businesses they invest in insightful advice. Number 2. The advantages of private equity. Private equity is a crucial source of funding for businesses, particularly those that are new and expanding quickly. In addition to providing debt and equity financing, private equity investors frequently participate actively in managing the companies they invest in. Access to funds, active management, flexibility, and exit strategy are all advantages of private equity. Private equity is a crucial funding source, particularly for startups and businesses that are expanding quickly. Investments in businesses that are either small or too risky for public markets are acceptable to private equity investors. Investors frequently participate actively in the management of the businesses they own. They can help management teams by offering insightful counsel and support. Investors in private equity are more adaptable than those in the public market. They can adjust their investment to meet the particular needs of the business. When investing, private equity investors frequently have an exit strategy in mind. At some point, they will sell their ownership part in the business, typically through a sale of the business or a public offering. Number 3. The risks of private equity. Private equity has substantial and genuine risks. These include the potential for money loss, poor investment performance, greater leverage, and potential conflict of interest. Loss of capital is a possibility. A high-risk, high-reward investment technique is private equity. Despite the significant potential returns, investors must be aware of the associated risks. The case of financial loss is one of the most significant hazards. Private equity investments frequently include substantial levels of leverage, which increases the risk of loss relative to less leveraged assets. One risk is having poor investing results. Private equity investments also include the risk of subpar investment performance in addition to the risk of capital loss. Private equity firms frequently make investments in underperforming or needing a turnaround businesses. As a result, there is a higher chance that these investments will underperform. Increased leverage is another risk connected to private equity investing. The use of debt to finance a venture is known as leverage. In order to finance their investments, private equity firms frequently utilize leverage, which can increase returns if an investment goes well, but also increase losses if an investment does not perform as anticipated. Finally, the conflicts of interest that private equity firms frequently face can affect how they invest. Private equity firms, for instance, can be enticed to invest in businesses that are somehow associated with their own. Conflicts of interest may result from this, which is only sometimes in the best interests of investors. 4. Purchasing private equity funds. Access to a broad pool of investments unrelated to the stock market is one of the main advantages of investing in private equity. This implies that private equity investments may increase even during market decline, and vice versa. Consider investing in private equity. First, investing in private equity is a long-term strategy. A private equity fund's standard investment horizon is 5 to 7 years. Second, selling your investment before the fund matures can be challenging since private equity needs to be more liquid. If you're interested, there are a few ways to start investing in private equity. One choice is to put money into a publicly traded private equity company. A mutual fund that focuses on private equity investing is an additional choice. It's critical to conduct research and comprehend the dangers involved if you're considering investing in private equity. Private equity, though, can be a wise choice if you're prepared to assume some risk in exchange for the chance of substantial gains. 5. How do private equity funds operate? An investor-driven private equity fund first seeks for cash commitments. The fund manager may concentrate on a particular strategy, for example, venture capital, an industry, for example, technology or healthcare, a geographic area, for example, the United States or Asia, or a combination of these. The fund manager would then gradually request money from investors to buy private businesses. The private equity manager examines a variety of alternatives and picks the most profitable private businesses. To assure the feasibility of the investment, comprehensive due diligence is performed prior to acquisition. Following the acquisition, the private equity manager collaborates with the private company's management to increase value through boosting sales and profitability throughout the holding period, usually 3 to 5 years. After value has been created, the investment is sold to a strategic buyer, another private equity firm, or through an IPO. Private equity funds need larger teams to source purchases, carry out due diligence, work with portfolio firms to enhance their operations, and manage the exit. They also need intensive hands-on management at every level. It could take 10 years to raise funds, buy businesses, add value, and finally sell an investment. Investors would, however, reap profits as investments are realized over time and are likely to recoup their capital investments in a shorter amount of time. You must invest with dependable, knowledgeable fund managers. Number 6. Is private equity the perfect fit for me? Private equity is a tempting approach to get outsized returns for investors who are willing to lock up their money for up to 10 years. Yet, private equity has its problems. It is complicated and demands deep industry or location-specific knowledge. Private equity funds often look for commitments of $5 million to $25 million USD. Despite its appealing qualities, focusing only some of your investments in private equity. Private equity, on the other hand, enhances portfolio diversity and long-term risk-adjusted returns. This is another knowledgeable topic for today, and if you are interested in getting into private equity, hopefully all the things that we have enumerated helped you in considering things. Of course, when you are in business, you have to be sure what method or path you are taking. What do you think about this topic? Do you agree with me too? Share your thoughts in the comment section below. Don't forget to like, share, and subscribe. I'll see you in the next video.